Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's podcast. I'm thrilled to have with us Nelson Chu, who is the founder and CEO of Percent. Percent is a private credit marketplace and fintech, and I'm really excited to talk to him about his founding experience as well as the markets in which he operates.
Thanks so much for having me.
Wonderful to have you. Let's start with a bit of your inspiration for building Percent and coming to the idea of the company. What were the things that you were doing right before, and how did all of the inspiration strike?
For sure. So just to rewind a little bit about my background and what I was doing right before this, I had a consulting company that helped other founders build their companies from the ground up. And so we did everything from product to marketing to branding to engineering. And I did start my career in finance. So a lot of these clients that we got were usually fintech clients, for better or worse, right? Because I was trying to get out of the finance world and still it kept pulling me back in. So having done that for about 5 years or so, I realized that, you know what? Services, a little bit annoying, a little bit tiring, don't really want to keep doing that. And I saw an opportunity to say, hey, you know what? Why don't we do something the old-fashioned venture-backed way? And that's really how the idea, or at least the push to create Percent came to be. So back in 2017, 2018, we were trying to take a look at the market landscape, see what was out there. And we also recognized that, the idea on the napkin that you wrote when you start a company isn't usually where you end up. So just start with a halfway decent idea and you can figure it out from there. And we saw there was an opportunity to really create a better alternative investment platform, specifically for credit investors and all of that, right? And so what we thought was, okay, there's like a lot of platforms that are out there. The durations that they force you to invest into is super long. It's like 4 to 5 years. The minimums are pretty high, like 25, 50 grand. And the yields for anything that was a yielding product was kind of the same. It was like 9 to 16% back in 2017, 2018. So we figured if we could create a shorter duration, like a 1 month, 2 month product, and a lower minimum product, like $500, and our yields were comparable to everybody else, then we could have an interesting company and we'll figure it out from there. And that worked out quite well until we realized there was no tech in the space whatsoever to speak of. And that's how we really pushed to evolve the company into what it is today, which is really an infrastructure provider for private credit markets and kind of beyond, hopefully, if we can.
Was this the only idea you were considering at the time? If you were involved in kind of the startup world and thinking quickly through helping founders and so on, were there other things that were close to this idea that were on your mind?
There were. This is a blast from the past. I haven't had to think about this in a long time. I'm trying to figure out what other things we had. I want to say that was during the time when it was like peak ICO, peak crypto. And so there was definitely some questions whether we want to do something in that space. And we ended up saying, you know what? The regulatory landscape there is a little bit too crazy, a little bit too uncertain. Why don't we do something that's much more, I would say, maybe above board, that we know that we're not going to run into trouble with the regulators for? And also, I think given just our backgrounds, it was easier to create a platform like this versus something that was like hardcore infrastructure at the time, just because we didn't have the skill set to do something that was very like deep tech, even in the fintech space.
So around the time, I think we had some of the established P2P lenders, and I think they were still seen as pretty good businesses, even gone public. But you say there was no infrastructure really for these kinds of alternative investments. What do you mean there is no infrastructure? Like, what would it mean for there to be something in place? And what does it mean for there to be nothing in place? Like, what is the thing that was missing?
For sure. And I think I would separate out like P2P lending from alternative investment platforms. They're a little bit different. So P2P lending at that point in time, before 2017 actually, was going to be like your Prospers, your Avants, your lending clubs and things like that. That was almost like Gen 1 of lending, or V1 of lending for fintech, which is fine. And they did, generally perfectly fine. I think they realized over time that relying upon individual investors is probably not the best thing and you should just go more institutional. I think all of them realized that and you saw them push in that direction. Lending Club said, you know what, I should just, remove my cost of capital altogether and get a banking license. So there's that. And that's worked out well for them. But the alternative investment platform side, there was no shortage of them, right? So we had Yield Street, Republic, AngelList, Fundrise, Ground Floor, things like that. Those were all around during that time. And those are the ones that we thought, they're interesting opportunities. No one's really focused specifically on private credit. And no one's really done a super short duration product with predictable yield, right? And that's really how we felt there was an opportunity there. And it was when we started to do the deals ourselves, because it is a three-sided market with borrowers who need money, investors who have money, and somebody who sits in the middle trying to underwrite and structure these transactions, that we realized that the tech itself to get these deals out the door was non-existent. Everything from sourcing a borrower to structuring a transaction to syndicating it out to an investor base. We were doing everything from order book management on Google Sheets to compliance attestations via Typeform to asset surveillance via very, very poor Excel emails to us, essentially, that we were trying to normalize. So it was super, super manual. And we recognized that that was the opportunity in front of us at this point to be able to kind of evolve the company at that stage. But that was easier said than done because infrastructure in general is super hard to build and takes a long time, even more so in very, very entrenched markets like private credit, which is very reluctant to change.
Interesting. So maybe we can open up a little bit more the asset class itself. What does it look like? What does it mean to invest in short duration fixed income? What kind of yields are available? Who usually invests and holds these instruments? And kind of where do they fit in an asset allocation?
That's a great question. And it's worth probably going back in time a little bit to sort of the history of private credit. So private credit actually has been around for a very long time. It just hasn't really come to the forefront until I would say maybe post-global financial crisis. During that time, the banks pretty much got a slap on the wrist saying, you can't do this type of lending anymore. We're going to make it very expensive. Right? The regulators came in and said, we don't really like your behavior. And so it was cost prohibitive for them to do a lot of the small business lending, consumer lending they had been doing at the time. And the problem is, or the good news is for private credit, that the demand from these SMBs and these consumers didn't go away, right? They still needed those loans. They just need to find somewhere else to be able to fulfill that need, or fulfill that gap. And that's really how private credit really, really came to the forefront. So private credit, the easiest way to think about it is really just non-bank lending. So banks have a balance sheet. They can lend against it, right? Their cost of capital is super low. A non-bank lender doesn't have a balance sheet. So they have to raise capital from elsewhere to be able to finance their, whatever it is, their loan portfolio or their company, right? So think of I would say SoFi before they turned public, or Affirm before they went public, or any buy now, pay later shop. Those are all effectively private credit, right? It's non-bank lending. They don't have a balance sheet, so they have to raise money from elsewhere to finance their loan portfolio. And depending on what type of stage they're at, how much money they need, that financing can come from a wide variety of people. It could be retail investors, it could be family offices, it could be investment advisors, all the way up to large asset managers. So there was a huge growth of private credit post the GFC. And then you're seeing it again now with the regulators coming in and having a watchful eye on the banks again, that private credit is coming to the forefront. You kind of hear about it all the time these days. So for an investor in any of those spectrum of sizes, whether you're retail accredited all the way up to an asset manager, the goal is to be able to invest in these opportunities and get, I would say, it depends on the riskiness of the asset, but you can have things like low single-digit returns to high teens, low 20s, depending on, again, sort of the stage of the underlying borrower and how much risk is involved in that portfolio. And these are durations that could range from 1 month all the way up to many, many years, especially the larger you go.
Can we contextualize the asset just within the credit cycle that we've experienced since 2018? I'm curious as to, things like defaults. What did you see in terms of the exposures that you were providing on the marketplace, as well as the interactions with the interest rates going up, stalling out? How does the investment perform across these things?
Yeah, we did an interesting kind of look back over time around the riskiness and the performance of the lower middle market, which is like smaller deals, middle market, and the larger deals. So across the entire spectrum. And the gut reaction is kind of that, the larger it is that you go, the less chance of default that you have, the lower risk that you have. And the smaller you go, the higher chance of risk, and the yield is so much higher and things like that, right? That's kind of your gut reaction. What we found was that there's not really a ton of correlation between size. It actually is tied to leverage. So if it's not levered up, then generally the performance is fairly consistent and fairly similar. And that's because unlike equities, fixed income, you can structure a lot of the risk away, right? Like, so for example, for easy math, let's say somebody has a $100 loan portfolio. The reality is you can say, yeah, I'm going to loan you $100 to have you lend out $100, right? That's 100% LTV effectively. It's pretty risky. There's not a lot of, coverage there in case something goes south. But you can say, instead of $100, I'll give you $60, right? And then you got to go find the other 40. And so if that's the case, then your actual risk on a portfolio of assets that's worth $100 is only $60, and the performance could be very good as a result of that, right? So all these different levers that are built into credit give you that opportunity to structure away a lot of that risk. And so during this credit cycle in particular, we've seen definitely the ups and downs. There was COVID, obviously. During that time frame, you had all these businesses shut down. SME lending is a huge chunk of the private credit market. And there was a ton of risk trying to invest into SMBs at that point in time, or SMB financing at that point in time, because there was no cash flows coming to these businesses. So when we went out to market with our various different SMB lending opportunities, we saw investors just balk at the risk, right? What used to be 11% in terms of yield spiked to about 18% over the course of 9 months. I have never seen something spike so quickly, because that was the going rate for what an investor would feel comfortable with in taking on that risk to even consider investing in an SMB loan portfolio. On the flip side, there was a ton of movement into like e-com, right? And mobile apps and things like that, because everyone was stuck at home. Everyone was ordering stuff. That stuff performed so well. There was so much demand for that type of investment that the yields for those dropped into like the low single digits, right? Because everybody wanted it. And if everybody wants it, the yield comes down, the borrower wins, right? They get a lower cost of capital. So there is a real-time reaction from investors to general macro trends. And now recently, we've seen as well, right? The rates themselves have picked up for many of these asset classes because the Fed has increased rates as well. The risk-free rate is now higher, and there's a direct correlation between a higher risk-free rate and what investors want to get in terms of returns on their non-risk-free portfolio, right? So on average, a retail credit investor generally wants like 10 to 12% above the risk-free rate. A family office would want like 8 to 10%, and a credit fund would want 6 to 8% above the risk-free rate. We've seen that play out consistently. So recently, in the last, call it year and a half or so, we've seen the investors demand a lot more yields in exchange for taking on what they perceive as risk. And you saw it increase every time the Fed raised rates. And then now that the Fed has said, we're going to keep it pretty constant, we're going to plateau it, and then hopefully maybe drop it over time, we've seen the rates plateau on the platform as well. But as of right now, the weighted average rate on our platform, at the very least, is higher than it was during peak COVID, which tells you something, right? Like people are feeling like they want to earn more because the risk-free rate is so much higher, even though the risk is technically should be lower than it was during COVID when everything was shut down.
I'm curious to compare kind of the behavior of investors at different points of time. So if you look at, maybe pre-COVID versus now, and you look at the types of instruments that you offer on the platform, whether they are SME financing or corporate loans or other things that you offer, what was the most popular thing on the platform? Like, which of the financial instruments receive the most attention and the most flow, and has that changed?
I think it's constantly evolving based on how people feel about risk, right? So during COVID, SMB lending was by far the least interesting, and we had to keep spiking the rates to find a clearing price. And the truth is, what's interesting, at least for fixed income, is that there is a buyer at some price always, right? Like somebody out there is going to be like, yeah, this is priced properly for the risk. I'm willing to take that risk. So you can find what that happy medium is going to be if you just, let the market do its thing in a free market. The interest in e-com and all of that was, like I said, super, super high during COVID. That has now waned, right? Like you're seeing even in the startup ecosystem, the likes like Thrasio and a lot of other e-com aggregators have been struggling because the desire and propensity for e-com has kind of leveled out back to the way it used to be. And so the interest level in that from an investor has gone down as well. I think consumer lending was fine during, I would say, maybe around pre-COVID, during COVID, like that was all performing okay. But nowadays, with inflation where it is, you're seeing a lot of defaults and at least just like delinquencies coming out of the consumer loan portfolios that investors are a little more skittish about consumer loans as well. And I think the value prop for our platform, at least, is that we do make it very transparent how the portfolio of loans are doing, right? So you're seeing every week, every month, the actual performance of the underlying assets. So they can see that, for example, consumer loan delinquencies have gone up, and they can choose to either not invest in that going forward, or they're going to say, I need this rate to be higher to even be interesting for me. So we give them a lot of flexibility and optionality to decide whether that is the right type of investment for them. Now, within private credit, there's two types of asset classes. There's asset-backed, which is, again, small business lending, consumer lending. Think of it as like a large portfolio of loans, and you're investing in a pool, effectively, right? There's also corporate debt, like you mentioned. And corporate debt ranges from like venture debt, which is super small, not profitable companies, all the way up to super profitable, very large companies. We've done some corporate debt. We've done some venture debt. That was appealing, I think, earlier on in the cycle. And then as the venture equity market has been more and more frozen, thawing slightly now, but still, not the greatest unless you're an AI company, the desire for venture debt has waned unless it's at a crazy high rate. But then when it's at a crazy high rate, people are wondering if this is even going to be possible for the company to kind of right-size itself over time, right? So they're weighing that as well. So the beauty of private credit, the beauty of our marketplace and our platform, at least, is that because these deals come to market so frequently and they refinance so frequently, we do get a real-time pulse check on what investor appetite is for what types of asset classes. And you just don't really see that anywhere else.
Can you tell us the scale of your footprint, like in terms of whether it's volume or notional or number of users or offerings? What is it that you track as a sign of progress, and where are you in terms of that?
Just to be, fully transparent, we do kind of run two companies in-house or two businesses in-house, right? We have a marketplace business that really helped us get to where we are today, which is it's done about, I would say, maybe $1 billion and change in volume at this point. It has done over 550 deals. Like, it's very, very active. And that's been over the course of the last 5 years, roughly. And that's been working out just fine for us, right? And the KPI for that is just strictly AUM. So what is it? We're in early March right now, 2024. We are tracking at about 170 million in AUM, which is totally fine. The broader private credit market is 1.7 trillion. So you can do the math as to what market penetration we have on that side, which is, again, totally fine, right? The marketplace has always been a means to an end for us to be able to learn how to do transactions at scale and at speed, to be able to figure out what we need to build on the software side. So the other arm of our business is the software business, where we do provide the infrastructure to be able to source, structure, syndicate, service, and surveillance various different private credit opportunities, selling it as a pure play SaaS product to the later stage side of the market. That would be, hopefully, over time, the Apollos, Ares, Blackstones, KKRs of the world. That's our, grail in terms of a client. But we're going to start smaller, obviously. And that side is just kind of getting off the ground, right? That segment will be able to actually service the later stage side and not the kind of small, lower middle market that our marketplace today can do. So marketplace, keep growing AUM, we'll be fine. That's the biggest KPI, right? Keep doing volume, keep getting more of these various different underwriters on board to help do deals for them, raise them capital. That's all okay. The software side is how much penetration can we get at what segment of the market, and how do we continue to go more and more upmarket and larger over time?
So let's talk about the infrastructure part of it, the software part, in terms of what you needed to build. Can you walk us through how you designed that, and maybe what is it that each of the stakeholders in your three-sided network wants? How do you prioritize them? How do you stay customer-centric when you've got users that might want very different things and might be coming, one's from an institutional background and expect different experiences?
No, that's a really good question. And we, I think, struggle or battle ourselves with that every single day. The nice part is the marketplace that we've built for the better part of 5.5 years has always been a sandbox for us, right? So when we first got started, we were doing everything manually. I would say I am embarrassed by how poor our investor experience was when we launched this in like the middle of 2019. But you know what? If you're not embarrassed, then you launched too late, right? So that's always the case. So totally fine. We were sending out hello sign documents to investors like hours after they actioned the investment. We got the order into our very, very poor order book management system, which was just basically hard-coded text. And then we were building the order book via Google Sheets, trying to allocate people pro rata, prioritize some investors, deprioritize other investors, and then manually plug into the system after, right? That was the process when we first got started. There was no admin portal. There was no borrower portal. There was no underwriter portal. It was just investors. So fast forward over the years, having done over $1 billion in volume, 575 transactions, we learned by doing how to actually build features that make our lives more efficient, right? So the whole premise in terms of prioritization is really easy. It's how do we remove ourselves from the equation so that these three market participants, the borrowers who need money, the underwriters who structure these deals, and the investors who want to invest in this, are able to transact together for the very first time with very little involvement from us in being able to help them do that deal, right? So that is sort of our North Star from a product standpoint. And so that means that we built a dynamic order book syndication process where they can set a rate range. Investors can then say what ranges they want to invest in and for how much. And then they can use that, see the order book. Underwriters can then close that and basically make allocations themselves. There's like workflow between the underwriter and the borrower around diligence, post-close reporting, things like that. So every single step of the way, every sprint that we released was designed to make our lives more efficient. And in turn, that would mean it would make everybody else's lives more efficient as well. And so when I talk about the software and where we're headed, the reality is I would love to be able to close Apollo tomorrow, right? That would be fantastic. I also know that I am so far away from that. And so we're taking a very pragmatic approach. It's let's go with who we know. Right, so we know the lower middle market, these smaller credit funds, smaller sell-side shops, smaller boutique advisory firms who are doing 10, 20, 30, $50 million transactions. And some of them are clients already today on the marketplace. Let's upsell them. Let's cross-sell them on the software and get more users that way. We have a captive client base anyway, so that's great. And then as they do more transactions, we will build more features that we know will be helpful for them, which we know will be helpful for us to go up market as well. So it's a very, very, I think, tactical yet long-term approach to trying to solve this problem, leveraging an existing client base that we have and leveraging a lot of the learnings that we've had over the years from doing so many transactions. From here, it's all about client-driven product development, right? Like that is the name of the game here. And we'll have a lot of feedback because of that captive client base that we have.
Who are your power users? There's always a skew in terms of the profile of the users that find the platform really valuable. Have you identified those, and what are their characteristics, both in terms of some of the quantitative metrics, but also more in terms of the psychology, like who ends up being attracted?
Yeah, that's a really good question. And for those founders that are listening, some of you guys may be selling into a single target market or single target client demographic. Some of you may be a marketplace selling two sides, supply and demand. We have the fortune or misfortune, if you want to call it that, of trying to sell three sides, right? Which is extremely, extremely difficult in the grand scheme of things. But in terms of power users, I can break it down one by one. For the marketplace itself specifically, our borrowers tend to be, again, smaller, low and middle market, right? So between the asset-backed side and the corporate debt side, these are likely going to be either Series C, Series A, maybe Series B fintech lenders who are looking for growth capital to finance their loan portfolios. On the corporate debt side, it's going to be the same thing. I would say Series A, Series B, venture-backed companies, or EBITDA profitable companies, but a little smaller, right? That is sort of the sweet spot. And that's the space that we play in because there is a artificial cap in terms of how much capital the marketplace can actually physically raise for them. The average portfolio or issuance outstanding by any given borrower is roughly like 2.5 million, right? Nothing too crazy. We have some that are a couple 100,000, some that are 15, 20 million, but it's a wide range, but it still is within that range, right? So that will limit what type of clients you can get on that side. But the ones that we do get on that side are very happy with what we're able to do for them. On the investor side, we have multiple types of investors. I would say from a numbers standpoint, naturally, accredited investors are the power users or the highest volume of users because there's just more of them. So these accredited investors tend to like to invest into direct deals, create their own custom portfolio by investing themselves, things like that. But we are seeing more and more penetration and interest level from family offices and investment advisors because they want exposure to this segment of the private credit market that lower middle market that they can't get anywhere else today. They can't get it from Ares. They can't get it from Blackstone. We offer something pretty unique and pretty compelling on that side, to the point where we do expect that the capital deployed from this smaller audience of family office and investment advisors will outpace the likes of our accredited investors in short order. But that is going to be something that needs to build up over time, essentially. So number of users, lots of accredited investors, dollars deployed, probably going to be more on the institutional side when all is said and done. And then for underwriters, we know who they are, right? We had a reputation that we built over the course of 5 years, give or take. Everyone kind of understood that we were building a marketplace, but that we had aspirations to sell them this solution over time. And so a lot of the underwriters we brought on board are people that we've known for years. And these are going to be smaller shops, right? Buy side, sell side, doesn't matter. Anybody who has a client that's a borrower who needs money, and anybody who's looking to be able to raise outside capital, opportunistic capital, external capital they can't get themselves. These are all sort of the attributes that we see on a consistent basis, and it's been pretty tried and true over the last few years.
Let's talk about how you go to market and building the sales or business development or marketing organization. Again, because you have such a multi-pronged network that you have to bootstrap at the same time. Can you talk about sort of like the go-to-market function that you've built out and then how it works? And maybe if you had tried different channels and paths before that were the wrong way, that would also be really interesting.
For sure. I think in a three-sided market, you need to try and at least carve out one side, right, to be able to make it not really much of a problem. So we chose to be the underwriter in this instance. We took down that side. So we only would have to find borrowers and find investors at the outset until we had something we could sell to underwriters. For borrowers, this was in 2019, like nobody knew who we were, right? So we had to really get our name out there. So this was a kind of grassroots, boots on the ground. Let's go to all the conferences. Let's go to, back then it was called Lend It, and just basically speed date and network with all of these different fintech lenders that were out there, and then see how many we can get on board, right? So that was a very, very, I would say, not scalable strategy. But at the early stages, you do things that don't scale, which is totally fine. We were a little bit strategic though, right? Because we didn't just focus on US borrowers. We had aspirations, and we set our sights abroad and internationally as well. And the beauty of international is that most of the companies in each of these sectors kind of know each other, like all the competitors know each other, right? So whenever we went into a country, let's say it was like Colombia or Peru or something like, or Mexico, we did one company or we helped support one borrower in that space. And then all the other competitors in that country ended up reaching out saying, hey, I saw you did a deal with this company. Like, we do the same thing. Can we talk as well? So we ended up getting a little bit more scalability coming from that, which was great. And then over time, we built up a reputation for ourselves that a lot of this ended up happening organically. Now, the truth is, we take on as clients to see that all the way through a deal, a very, very small proportion of the actual borrowers who are interested in raising capital on Percent, right? So we actually ended up having a pipeline that was way bigger than we could even support anyway. And that happened naturally and organically over time, which is great. Now, as we got bigger and as the platform became much more sustainable on its own, and we opened up the platform for other underwriters like these sell-side shops, buy-side shops to come on board, they then take down another side themselves, so we don't have to worry about it, right? They bring their clients, they bring their borrowers. So we knew that at this point, I don't need to find any more borrowers. They're all coming with 5, 10 borrowers of their own that we're going to be perfectly fine just relying upon them. So our focus now is just to close underwriters, essentially. And we are leveraging multiple years of reputation, of history, of relationships with these underwriters to get them on board. Most of the underwriters we have as clients these days, they've known us, we've known them, and it's just a matter of when, not if, do they join the platform, right? Which makes our life a lot easier. Going to the other side, of investors, that's a very different animal. And the time it takes to acquire an investor depends upon how large or small they are. So the smaller they are, it's usually money related. The larger they are, it's more time related. So accredited investor, which is the smallest segment of this market of investors, that is going to be your conventional strategies, right? Let's go paid marketing. Let's do Google. Let's do Meta. Let's do LinkedIn, whatever. Let's target them that way. Expensive, but scalable, right? You can get lots of them that way. And then you also have various different sponsorships like newsletters, podcasts, things like that. And it is very much not necessarily trial and error, but there is obviously with any sort of growth hacking mentality, a constant iterative process in terms of like finding the right demographic, finding the right messaging, the targeting, things like that to be able to get it to work. So there's a lot of testing that happens on, for example, sponsoring a podcast, seeing who that audience is, things like that. And that all comes back with the numbers, and you see if you did a good job on that side, and you either rinse and repeat or you have to try something else. Now, as you get to family offices, investment advisors, and things like that, that's a very different ballgame, right? That's going to be very network related, very time related in terms of what it's going to take to get them. And so we do have people on the team whose job it is to literally talk to them, wine and dine them, go play golf with them, whatever it may be, right? To be able to get them to come on board. And we expect that from the first conversation till actually closing them and putting money onto the platform, 6 to 9 months, right? That is a very, very time-intensive discussion and requirement, but they come through in droves in terms of capital, way more than an accredited investor would. So it does pay for itself over time and then some. That's kind of the way it has to be, right? There's really no other way around it. What you can do to help is that obviously you can have products that are relevant to them, interesting for them, so that it's not a hard sell. But a lot of these guys still, even if it's not a hard sell, they want the relationship. They want to get to know you. They want to be able to trust you. And that is just literally a time function more than anything else.
That doesn't sound very easy.
Well, they get to play golf all the time, so it's not totally bad. But no, it's definitely not easy.
Going back to the tech and infra build in the platform, are there any custodial or other financial institutional sort of integrations that you have to do? Like, what are your dependencies from a regulatory perspective, and what do you have to build the pipes into and out of?
It's interesting, right? At the end of the day, if you were to look at our platform, you would say this is an amalgamation of a lot of different integrations that is almost like tailor-made for private credit, right? So for example, in the marketplace specifically, the need to do KYC, AML checks, things like that, accreditation checks, banking integrations to be able to basically access their bank account and pull cash when they want to make a deposit, the various different, I think, clear checks, like OFAC checks, things like that. Those are all things that are already built in other places, like layer one infrastructure from various other fintechs and companies that are out there, right? So we integrate all those into our platform. And the secret sauce and the proprietary nature of what we built is sort of the unique parts of the platform itself. But the bulk of it is very much just, I've seen it before, I've done it before, things like that. And you glue it all together, and then you have a cohesive experience with a little bit of sprinkle on top of what's unique to private credit. And then you now have a platform that nobody's seen before in an asset class that hasn't really had a lot of technology to speak of. So the bar is low in terms of what it takes to get into this space, because it is, again, an aggregation of a lot of different things. But the last 5% of what you need to build, that unique element of it, is what makes all the difference. And you can't really know what to build and what that 5% looks like until you've actually done transactions at scale, at volume, which is what we've done. So over the years, we become more and more unique and more specialized. And the value proposition for the clients has become better and better because we solve for what those 5% look like and not what the 95% was.
What are the things that you think would really unlock your business to go faster? I'm sure there are, whether it's the adoption curve by high net worth and family offices, or whether it's the sort of knowledge of the asset class. What are the biggest levers that you'd like to pull for the business to scale?
So on the marketplace side, it's supply and demand, right? And I would say, so supply being the supply of assets that you can invest into, and demand being demand from investors who want to put money to work. It's pretty, I think, well understood that if there is capital to be put to work, and if you have a very captive capital base, there are no shortage of people who want to take that money, right? So in terms of just pure acceleration, if we have, let's say, $1 billion on one side of capital that's looking to get put to work into private credit, yeah, we're going to grow very quickly if that's the case. But at the same time, you also have to be very cognizant of like your credit box, right? You can't just throw anything onto the platform. That level of risk control and just credit risk management still needs to be paramount here. So there's going to be a limitation on how fast we can capitalize on, let's say, that hypothetical billion by where the quality of assets are coming from. But that's a much better position to be in than trying to constantly say, do we have enough capital to fill this deal? Things like that, right? In a real world scenario, because no one comes with a hypothetical billion and puts it to work or realizes that, it's a bit of a step ladder, right? So you have a situation where you have excess demand, not by a lot, but excess demand, and then not enough supply of assets. and you go out there and chase more assets, and now you have excess supply and not enough demand, and you just keep step laddering up to get your AUM to where you want it to be. That's a very, very common trend in financial services and in wealth management, asset management products as a whole. So pretty tried and true on that side. On the software side, this is literally just resources, right? Like our roadmap goes out like 2-3 years at this point. We need to be able to get there. But the beauty of, I think, us having two arms of our business is that the marketplace itself, which is, again, pretty well understood at this point. We know if we put in $1, we're going to get X dollars back, right? From a revenue standpoint. If that's the case, that is going to be able to get us to profitability. That's going to be able to have us spit out free cash flow. And we have all the options and time in the world to really figure out how to properly go after the software market, the enterprise sales market that's more upmarket from where we're playing today. So we're taking a very pragmatic approach to how to do this. And we're fortunate that we do have two arms of the business, one that can support the other and buy us the time that we need to be able to be successful over time in a very pragmatic fashion and not like just, throwing money at a problem and seeing what sticks and what doesn't.
If you look forward at the macroeconomic environment and the expectation that rates are going to go down, what effect do you think that'll have on private credit as a whole? At a very top level, we're seeing a bunch of weird stuff, right? Where people were attracted by the relatively high interest rates and came into fixed income, and you had these unintentional effects of blowing up a whole bunch of banks because of their liabilities being improperly hedged. And at the same time, huge demand for additional fixed income product. And now we're on the cusp of a change in the other direction. Are there consequences or sort of macro issues that you're paying attention to or are concerned about as it would have an effect on, asset allocations more generally or the asset class?
For sure. I would separate out the larger, later stage segments of private credit from the stage that we play in on the marketplace side. So on the marketplace side, we've been through so many cycles at this point. Like we started in almost like a zero interest rate environment, right? So that's not new to us. It's literally that sliding scale. Retail investors want 10 to 12% above the risk-free rate. If the risk-free rate is zero, they're going to want 10 to 12%, basically. And so you see that reaction constantly and that recalibration from these investors on a regular basis. And you'll see the rates on the platform come down, right? Rates coming down actually is beneficial for the borrower, obviously, right? The cost of capital is much more affordable. They can actually be able to earn a bigger spread for themselves to operate their business. Likelihood of them being successful over the long term is higher, right? That's all good. The ability for defaults to go down as a result of that also improves, right? Because, for example, if the rates are high, the cost of capital for the borrower is also high. They have to pass that on to the underlying borrower, that small business, that consumer, who, puts a lot of pressure on them, right, to be able to perform and pay on time and things like that. So lowering the rates naturally will make this system just a lot smoother and a lot better for everybody as a result. On the later stage side of private credit came into the forefront because of the fact that banks weren't really involved, right? And so they had to take a step back. They are now actively looking to get involved to make sure that they are not getting left out in this instance. And so when you have a situation where the rates are super low, the ability for a bank to be able to then actually provide attractive cost of capital goes up again, right? So it's going to get interesting in terms of how these larger shops compete. But as of right now, the larger shops are the best option on the street right now because there's no other groups that can actually give them the money, these borrowers the money they need. So we'll see this all play out. It'll be very interesting to see. But again, I don't think we're going back down to zero interest rates anymore, not for a while at least. And I'd be surprised if we do ever touch that again for the foreseeable future. So given that's the case, given how much money has been raised in private credit, given how much demand there is for uncorrelated returns to the equity markets, you're going to see, I think, continued growth and demand for private credit. And I think the latest stats have it that this should be a $2.5 trillion market in the next 2-3 years, roughly, give or take. So it is growing very quickly. I've seen, this is not my first downturn or anything like that. So I have seen when something grows that quickly, it generally comes down as well. But I think the benefit of being in private markets versus public markets, which is where a lot of these issues have happened in the past, is that private markets tend to be a little more insulated, a little bit more opaque, and that opacity actually helps recalibrate the system and ensure that there's no systemic risk across the board, which will help in this instance.
One more thought from my side, and I'm curious if there are trends that support this, and in particular, the importance of data and data aggregation becoming more and more obvious as we have technologies like machine learning and generative AI being used in more and more in financial services. For a lot of the markets in finance that have been historically underserved by technology, you don't have kind of really strong data chassis. What are you seeing from that perspective in terms of improving industry-wide data, and what are the kinds of doors that you see opening up as a result of that?
Yeah, I think AI is on the tip of everyone's tongue, right? They're trying to figure out how to either make it work in their existing solution or shoehorn it in one way or the other. We use AI on a regular basis today for things that you would expect, right? So, for example, marketing, there's a lot of benefits to having AI just spit out, webinar agendas and like kind of boilerplate content, social posts, things like that, just to be able to get some economies of scale there. Fine, right? Not groundbreaking, but save some time. So cool. For engineering, there's definitely, Copilot, things like that help. Doesn't solve your problem, but it helps, right? Gets you a good starting point or a good sanity check. So that's all fine. We are a very, very far way away from having AI do any sort of recommendations around financial advisory, which I know where people are looking at. Like the regulators are going to have a field day around trying to figure out how to even regulate AI given recommendations because of how, I would say, potentially off they are, essentially. So you're going to have FAs still play a role and sanity check whatever the FA is coming out, the AI is coming out with. But the reality is it's coming in some way, shape, or form. And what we are positioning for is the fact that the data that we have will be the most valuable, right? I envision a world where all the models, language models, whatever models they come out with, will all kind of coalesce around the same point. You can see it right now in the benchmark scoring. They're not that far off from one another, right? And they're all going to kind of do the same exact thing over time. So the value is going to come from what proprietary data set do you have or do we have that is going to be able to be intrinsically interesting for the target client base. And so we position ourselves well for that. We have monitored and tracked and analyzed, I think, like 7.5 billion data points at this point, roughly, give or take, around underlying asset performance. So all the portfolios of loans across these SMB lenders, consumer lenders, corporate borrowers, things like that, to be able to actually put it into a model and say, show me performance over time. Show me how you think this will happen if performance dips like this. Like that's all super valuable information where in a day and an age where the models themselves can be trusted not to hallucinate all the time, we'll be in a good spot to be able to capitalize upon that and present really interesting data and really interesting ways to manipulate the data that no one else has. Because this is, again, proprietary to us. So those who own the proprietary data set own the power in an AI-driven future. And you're seeing that with Quora, with Reddit, and all these other places that have really large data sets where these models like OpenAI, Anthropic, they're all looking to pay money for it, right? Google paid a ton of money for Reddit's data to be able to actually do something with it. So we hold the data. I think we'll hold the power in that instance. We want to make sure that we never lose sight of that fact.
It's a fascinating asset class, and I'd encourage all of our listeners to go and check out the website and learn more about it. So, Nelson, where should our listeners go, and how can they follow you and the company?
For sure. We're pretty easy to find. It's just percent.com. If you want to look up anything that we've done, it's free to sign up. You can view all these opportunities. So that's all great. I'm pretty easy to find as well. If you want to email me, if you have any questions, anything like that, always happy to chat. It's just nelson.chu, CHU, @percent.com. And recently, I actually also put out a website just because we have so much content. I've written so much content over the years. That's nelsonchu.co. And in that, I actually publish all of our weekly team emails that I write to everybody. So you can see, in the spirit of building in public, the trials and tribulations of founding and growing and scaling a startup over time, in addition to some of the other things I've written around the life of a founder, how to delegate, how to fundraise in this environment, things like that. So if that's helpful for anybody, you can definitely check that out, as well as you can kind of see our journey and how it's evolved over time.
Amazing. Thank you so much for joining me today.
Thanks so much for having me.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things FinTech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.